U.S. jobs report breaks forecast, big impact on markets. Detailed long-form analysis in English. The latest U.S. jobs report surprised economists and investors by coming in stronger than expected. Instead of signaling a slowdown, the labor market showed resilience, and that immediately shook financial markets. Stocks, bonds, the U.S. dollar, and interest rate expectations all reacted within minutes of the release. The report is published monthly by the Bureau of Labor Statistics, BLS, and is considered one of the most important economic indicators in the world. Below is a deep, structured breakdown of what happened, why it matters, and what could happen next. 1. What is the U.S. Jobs Report? Officially called the Employment Situation Report, it includes non-farm payrolls, NFP, number of jobs added or lost unemployment rate, percentage of people actively seeking work, average hourly earnings, wage growth, labor force participation rate, workforce engagement. This report reflects the overall health of the U.S. economy because consumer spending depends heavily on employment stability. Two forecasts versus reality economists had projected moderate job growth, around 80,000 to 100,000 new jobs. Instead, the economy added approximately 130,000 plus jobs, significantly beating expectations. Additional highlights. Unemployment rate edged down to roughly 4.3%. Wage growth remains stable and resilient. This indicates the labor market remains tight and stronger than anticipated. 3. Why this is so important. The labor market drives economic momentum. If jobs increase, consumers spend more, businesses grow, GDP strengthens. Jobs decline, spending slows, corporate earnings drop, recession risk rises. This stronger than expected report suggests the U.S. economy remains stable and resistant to slowdown pressures. 4. Stock market reaction. Financial markets reacted immediately and sharply. Major index moves, S&P 500, initially dipped, then partially recovered, Dow Jones Industrial Average. Mild pullback, NASDAQ Composite. Volatile trading, especially in tech stocks. Why the mixed reaction? Because stronger job data reduces the likelihood of near-term interest rate cuts. 5. Impact on Federal Reserve policy. The U.S. Central Bank, the Federal Reserve, closely monitors employment data. The Fed's dual mandate. 1. Maintain price stability, control inflation. 2. Maximize sustainable employment. A strong labor market means less urgency to cut interest rates, higher probability of keeping rates elevated longer. After this report, markets reduced expectations of early rate cuts. 6. Bond market response. Bond yields rose following the release. When investors expect higher interest rates for longer, Treasury yields increase. Bond prices fall. The 10-year Treasury yield saw upward pressure as investors adjusted rate expectations. 7. U.S. dollar strength. The U.S. dollar strengthened after the report. Higher rates make U.S. assets more attractive to global investors, increasing demand for the dollar. Turn. 8. Sector-by-sector impact technology. Tech stocks are sensitive to interest rates. Higher rates reduce the present value of future earnings, causing volatility. Financials. Banks may benefit from sustained higher interest rates through stronger net interest margins. Industrials. A strong labor market suggests continued production demand, supporting industrial stocks. 9. Wage growth and inflation concerns. Wage growth remains stable. If wages accelerate too quickly, businesses may raise prices. Inflation could re-accelerate. The Federal Reserve pays close attention to wage trends to prevent inflation from reigniting. Recession risk? At the moment, this data does not signal an imminent recession. Instead, it shows ongoing economic resilience, strong labor demand, continued consumer spending capacity. However, prolonged high interest rates could eventually slow growth. 11. Investor psychology. Markets often react not just to data, but to expectations. In this case, good economic news, but bad news for rate cut hopes. That explains the mixed and volatile market response. 12. What it means for investors. Short term, expect volatility. Rate-sensitive sectors may fluctuate. Long term, strong employment supports corporate earnings. Economic stability benefits diversified portfolios. 13. Housing market impact. If interest rates remain high, mortgage rates stay elevated. Housing demand may slow. The housing sector remains closely tied to Fed policy. 14. Global market influence. U.S. employment data affects Asian markets, European equities, gold prices, emerging markets. A stronger dollar often pressures gold in emerging economies. 15. Possible scenarios ahead. Scenario 1. Continued strong labor market, rate cuts delayed, ongoing market volatility. Scenario 2. Gradual cooling in hiring, Fed may cut rates later in the year, equity markets could rally. Scenario 3. Rapid wage acceleration, inflation risks return, Fed remains hawkish. 16. Final conclusion. The latest U.S. jobs report delivered a clear message. The labor market remains resilient despite economic uncertainties. While this is fundamentally positive for the economy, it complicates the outlook for interest rate cuts. That tension explains why markets reacted with volatility rather than celebration. This single data release reshaped expectations around monetary policy, stock valuations, bond yields, and the dollar, proving once again that employment data remains one of the most powerful economic signals in global finance.